Chapter 1. Introduction. Since the release of the third edition of my book Generational Wealth, Beginner's Business and Investing Guide, I have mostly dedicated myself to growing spiritually, and the result of my writing output since then has reflected my spiritual focus. However, in addition to my relationship with the Most High, I'm also extremely passionate about the stock market and investing overall. It was only a matter of time before I would expound beyond the basics of generational wealth, which was my way of introducing high-level financial literacy to those who have been either undereducated or miseducated in the areas of personal finance and basic economics. Being able to identify investments that have the potential to grow several-fold in a few short years is a necessary skill set for those who need to turn a small amount of money into a small fortune. Although no return is ever guaranteed when investing, giving yourself a high probability of success is a demonstration of self-respect and self-love, in my opinion. The stock market is a fun and exciting place to be when your stocks are rising, but it can also be a very depressing place to be invested when the market is being irrational and stocks are dropping to levels you would have never imagined were possible. I have been a witness to both on multiple occasions, so I hope that this book gives you a good idea of what to expect and a few extra tools to take advantage of the financial literacy that many of you acquired from generational wealth or any other source of financial literacy. Considering that some returns in life are immeasurable and more valuable than money, it was important that I include a chapter to assist with those who are also in need of spiritual literacy. I believe that financial and spiritual literacy are two of the most important and valuable tools for our journey through life, and it is my wish that readers of this book gain both knowledge and inspiration from my work. Chapter 2. 1,000% returns in the stock market. I prefer, when possible, to only invest in stocks that I believe have a reasonable chance to return 1,000% or more over 5-year periods due to a combination of earnings growth and multiple expansion. Multiple expansion refers to when the price-to-earnings ratio of a particular stock, or the market as a whole, is increased. For example, if a company earns $1 per share and sells for $10, the price-to-earnings ratio would be 10. If the company later trades for a price-to-earnings ratio of 11 or more, the increased multiple from 10 to 11 is what is referred to as multiple expansion. High-tech valuations using price-to-sales ratio. For startups and fast-growing, high-margin technology companies, price-to-sales is often the best measure for valuing the business, as many fast-growing companies are intentionally losing money by investing aggressively in new products and other means of future growth. Therefore, many fast-growing companies don't have any earnings, which makes the P/E ratio calculation impossible. To determine the price-to-sales ratio, divide the company's market capitalization by the company's revenue for the prior 12 months. Let's say a company has annual revenue of $1 billion and the market capitalization of the company is $10 billion. The price-to-sales ratio would be 10. The market capitalization of a company is determined by the number of shares outstanding multiplied by the share price. How to identify potential big winners? When looking for a potential big winner, it is important to look for a company that is expected to continue a trend of rapidly increasing sales and profits, and one that has a stock that is trading at an unreasonably low multiple to sales or earnings compared to its growth expectations. New industries that have bright futures and increasing institutional sponsorship are often where you will find future 1,000% and, if you're patient and lucky, 10,000% returners. Let's say you find a company that is emerging as the leader in a fast-growing industry. Let's say the company has 75% gross margins and has been growing revenue over the last 3 years between 50% and 100%. Let's also say that this growth is expected to continue and the company's products are sticky, resulting in high customer retention. Now, although the company has been growing revenue by over 50% per year, let's say that the company is trading at a low price-to-sales ratio of 7. For high-margin businesses, I believe it is reasonable to pay a price-to-sales ratio that is up to 33% of the expected growth rate over the next 5 years. For example, if a company is expected to grow revenues 30% a year for 5 years, I believe a price-to-sales ratio of 10 or less is very reasonable, and a price-to-sales ratio of 15 should be the absolute limit. There are always outliers, but these are my general valuation targets. For high-margin businesses such as software firms, operating margins can be expected to reach 30% or higher once the business matures, and a company with a price-to-sales ratio of 7 can be seen as having an imaginary price-to-earnings ratio of approximately 20 to 25, even if the company is currently losing money due to aggressive investment in growth. When a business has a large increase in revenues, it often increases profits by an even larger amount if it is starting from a low base. Typically, I like to calculate the PEG ratio, which compares the PE ratio to the company's expected growth in earnings. Let's say a company has a PE ratio of 20 and is expected to grow earnings by 40% a year. The PEG ratio would be 0.5, 20 divided by 40, which is very cheap. I believe a PEG ratio of 1 or less is considered very reasonable, and 0.5 or less is considered an absolute bargain as long as the business has a strong balance sheet, enough cash or cash combined with cash flow to cover debt payments, and is likely to sustain some measure of healthy growth well into the future. Doing the math. Let's say that the company that you are researching has a market capitalization of $7 billion and annual revenues of $1 billion. Since the company is expected to grow by at least 50% a year, 5 years of 50% growth would grow the revenues beyond $7.5 billion. After 5 years of 50% growth, let's say the company is then expected to grow revenue by 36% a year over the next 5 years. The appropriate price-to-sales ratio for a company with such metrics would be around 12 or more. To find a general 5-year price target, multiply the $7.59 billion in expected revenue by a multiple of 12, which equals $91 billion. A company that grows from a market capitalization of $7 billion to $91 billion would return 13x, or a 13-bagger. In this scenario, revenue grew 50% a year for 5 years from $1 billion to $7.59 billion, and the price-to-sales multiple expanded from 7 to 12, likely due to either an improved profile of the company, a change in market sentiment, or a raised profile in conjunction with a change in market sentiment. Do your own research and use your own brain. It is important to note 2 things. Companies that have great products and very large total addressable markets are often given credit for many years of future growth and can sometimes trade at price-to-sales ratios that exceed the rate of growth, which is too expensive for my style of investing. Also, it is vitally important to do your own company and industry research and independently decide how fast you think a company can grow in the future. Analyst estimates are often very wrong and, if relied upon, can cause you to miss out on some great opportunities. Timing a big winner. Usually when the market experiences corrections, drop of 10% or more, and bear markets, drop of 20% or more, the stocks of many fast-growing companies fall to much lower levels than what can be considered reasonable, and these environments often create the perfect climate to find your next reasonably priced big winner. Buying fast-growing companies when the market is crashing requires courage, conviction, and patience. Most investors are scared to buy stocks during market crashes because they think the risk is too high that stocks will continue to drop, and I admit that there is a good chance that they will. It is very hard to perfectly time the bottom when the stock market is crashing, and it shouldn't be the goal. The goal should be to buy stocks that you believe in because of your research when the valuation is so low that a magnificent return over a 5-year period is all but guaranteed. Low PE big winners. There are often opportunities to find stocks that return 1,000% over 5-year periods because of unreasonably low price-to-earnings ratios. In some cases, there are not any analysts covering the company, which causes the stock to not be on the radar of many institutional investors, such as pension funds, hedge funds, and large asset managers. Finding a company that is growing much faster than the average of the S&P 500 that also has a much lower price-to-earnings ratio than the S&P 500 is often worthy of investigation and strong consideration for entry into one's portfolio. It is important to make sure the company has long-term growth potential and a reasonably strong management team that has a track record of solid execution. Chances of success are also increased if management owns a large percentage of the company's stock, such as 20% or more. When the executives of the business own a large portion of the company, their interests are naturally aligned with shareholders, and decisions will often be made that are in the best interest of the company. Also, an executive that has a significant percentage of his or her net worth in the company will often treat the business with the same care as an entrepreneur managing his or her own business. Small companies that consistently perform well eventually get included into indexes, which forces money managers who mirror such indexes to purchase the stocks. If you find an unreasonably low PE company that has no or very little coverage from analysts that has been growing revenue, gross profit, operating margin, and net income consistently over the last 3 to 5 years, and you expect the good times to continue based on your research, it would be wise to model out what revenue and profits would look like in 5 years if the track record from the prior few years is extrapolated to the next 5 years. Once you have the projected figures, you can then estimate a multiple of sales and earnings for your bear, base, and bull cases. Bear case multiples would be lower because of possible recession or negative market sentiment. Base case multiples are what you would expect in a normal, healthy market. Bull case multiples are highest because they represent an environment where market sentiment is causing extreme optimism around the particular stock, industry, or market as a whole. You never know what to expect when modeling out for 5 years, so it's important to have models for all 3 scenarios. The road to 1,000%. Even if you buy the prospective big winner at a wonderful valuation, chances are the road to achieving such returns won't be smooth or without speed bumps. Although some 1,000% returns happen within a year or two, many more need 3 to 5 years, which usually include corrections and 1 or more periods of consolidation. In addition to speed bumps, your chosen stock may even have an accident or two, such as an earnings report that misses the expectations of analysts or a string of downgrades from investment banks that temporarily depress the stock. No stock goes up in a straight line, so it is important to have strong conviction in your research and to stay on top of the fundamentals of the company to make sure the story hasn't changed. A lot of great opportunities are missed because stocks temporarily drop below trend lines or key moving averages. A lot of traders and so-called investors immediately sell stocks that they believe in as soon as they drop below their 21-day or 50-day moving averages. After selling for silly reasons, many stocks of great companies have days where the stocks jump 30% or more, leaving previous owners behind and causing them to wonder why they ever sold the stock considering its fundamentals. Regardless of the sentiment surrounding a particular stock, I try to remember that the growth story is the growth story, and the valuation is the valuation. A stock cannot remain at an unreasonably low valuation in perpetuity. Eventually, investors will recognize the good deal or the private equity crowd will make the company a target. The stock price of a high-performance company almost always catches up to the value of the business. It's just a matter of time. Gross incompetence. There are many participants in the stock market, and many of them are brilliant, articulate, well-researched, and can be considered as independent thinkers and also as men and women of calm temperament. As a whole, however, I have a much different opinion about the money managers and individual investors that constitute the stock market. I have studied many great investors and traders. Combining my own experiences with the teachings of these great masters, I can confidently say that the stock market as a whole is grossly incompetent. Many stock market participants do what is popular instead of doing what is right. It may be popular to buy an overpriced stock that is growing slowly when inflation is high, but it would be more prudent over the long term to buy the underpriced stock that is attached to a business that is growing rapidly. Herd behavior is often exhibited by both institutional investors and retail participants that have been trained to invest or trade in whatever is working. This behavior explains why a company can grow its revenues and profits rapidly while its underpriced stock trades down or sideways for an extended period of time. After such time, however, the stock then appreciates by several-fold in just a 1 or 2 year period to compensate for the time it was neglected by investors. Despite the success of a business, if the stock isn't popular among the herd, the stock price will often, in the short term, not follow its growing fundamentals. At some point, however, investors of substantial buying power will emerge to change the fortunes of the mispriced stock, and then the stock has a chance to become a darling of the herd. The herd often loves stocks far longer than what is reasonable based on an independent study of fundamentals. The herd is often irrational and incompetent, which creates great opportunities to find mispriced stocks that will deliver marvelous returns over the long run. The incompetence of the herd will also provide you with opportunities to sell certain stocks at peak valuations that you know have risen to levels that make little sense. As I already stated, it is important to use your own brain and not attempt to delegate your duty of critical thinking to the herd. Members of the herd will often appear on business news media, for example, and advise viewers to invest in overpriced stocks or, even worse, in dying industries just because they are expected to have a strong year. Different gifts. I am of the belief that we were all, to some degree, blessed with different gifts, and it is not my intention to negatively judge anyone that lacks competency when it comes to analyzing businesses and predicting ranges of future outcomes. Some of us were blessed with an abundance of foresight, and some of us lack foresight but can gain a tremendous amount of value from the use of hindsight. Some of us lack both foresight and hindsight, but we're blessed with other amazing gifts that allow us to deliver a tremendous amount of value to the world. It is not my place to say that one gift is better than the other, but I do believe that the financial services industry has attracted a plethora of human capital that would be better aligned in other lines of work. I believe there are many hedge fund and institutional investors who would be better suited as doctors, lawyers, scientists, software engineers, and many other occupations. Unfortunately, we live in a world that has supported practices that misplace people throughout our society. For example, many cultures and families believe it is righteous to pick careers for their children without regard to the strengths or interests of the children. After discovering that they are in the wrong occupations, many people, likely due to sunk costs, are unwilling to transition to fields of work that more appropriately suit their divine gifts. I believe that many money managers know that they lack competency, but many of them are able to block out the thought. Many money managers, due to their incompetency, tend to only invest in the most popular stocks because of the assurance that if they perform poorly, so will many of their colleagues. This practice offers some level of job security, but almost guarantees that the clients of such money managers will miss out on most of the life-changing opportunities. This practice is, in my opinion, very unprofessional, but on the positive side, has created a large number of incredible growth stock opportunities as of early 2022, as inflation and interest rate concerns have made such stocks extremely unpopular. Generational Wealth, Beginner's Business and Investing Guide, 3rd edition. Becoming financially literate greatly improves your chance of recognizing poor advice when it is given, and also allows you to confidently make your own decisions when the stock market has created exceptional opportunities to build wealth. To become financially literate and a master of basic financial and economic concepts, I strongly recommend that you read the 3rd edition of my book, Generational Wealth, Beginner's Business and Investing Guide, which is available on Amazon.com.